Into our continuation, we were on the basis of valuation is the prime cost of the goods plus expenses for shipping, freight for which the assured is liable, and the cost of insurance plus 10%. So Section 23 of the Act states a contract of marine insurance is deemed to be concluded when the proposal of the insured is accepted by the insurer, whether the policy is issued or not, reference may be made to the ship. So covering note or another memorandum. Now we have the marine policy now. This is now the key policy that covers our investment over the sea. So the marine policy, section 24 of the Marine Insurance Act, that is of 1963, states that a contract of marine insurance shall not be admitted in evidence unless it is embodied in a marine policy in accordance with this act. So the policy may be executed and issued either at the time when the contract is concluded or afterwards. And now when you read section 25 of the same act, say that the policy must specify the name of the assured or of some person who effect the insurance on his behalf. It must also have the subject matter being insured and what type of risk are you insuring against, because we have different types of risk, so you must be specific. The sum which you are insuring, the sum assured. So as I'm saying that the subject matter which you're which you're insuring, the sum amount which you're insuring, because sometimes we may not insure the entire thing. Maybe if you are doing what called double insurance, then also the sum, or the name of the insurer or the insurer or the insurers if there are many. Then policy schedule. The standard form of the marine policy has a schedule showing the following details. One, we have the policy number, place, and date of that particular issue. Two, we have the name of assured with an address where the transaction is financed by a bank, the name of that particular bank. Also, we have the description of the voyage or transit, the subject matter being insured, the risk covered or the risk which are excluded. Then surveyor's note. Now, the surveyor's note, contains the name. Remember, the surveyors, these are now the people who normally they will conduct the survey in the event the risk has occurred. So they will come and conduct their own survey and give a report. So what does it contain? The name and the address of the surveyor who may be contacted at the destination point to conduct a survey on the damaged goods. The name and the address of the claim setting office at the destination who may be contacted for the claim, could be service process. Now we have 5 major processes of transaction which are carried out in international trade. One, we can do what's called the prepayment. This occurs when the payment of a debt or installment payment is done before the due date. So it can include the entire balance or any upcoming part of the entire payment paid in advance or of the due date. So in this type of transaction, the borrower is obligated by the contract to pay for the due amount Its example include like rent or loan, repayment, things like that. Now, letter of credit, which is a very, very common letter in international trade, is simply a letter from the bank that guarantees that the payment due by the buyer to a seller will be made timely for the given amount. So in case the buyer cannot make payment, the bank will cover the entire or the remaining portion of that particular shipment. Then draft, we have got two types of draft. You have the site draft and the time draft. Is a kind of bill of exchange where the exporter owns the title to the transported goods until the time the importer acknowledges and pays for them. Now, side drafts are usually found in case of air shipment and ocean shipments for financing the transaction of goods in case of international trade. Then we have the time draft. It is simply a type of foreign check guaranteed by a bank, but it is not payable in full until the duration of time after it is obtained and accepted. So they are short-term credit vehicle used for financing goods transactions in international trade. Then we have this other term, which is common, a consignment is simply an arrangement to leave the goods in the possession of another party to sell. Typically, the party that sells receives a good percentage of the sale. So they are used to sell a variety of products, including artwork, clothing, books, and of late, consignment dealers have become quite trendy, such as those offering specialty items, infant clothing, and luxurious fashion items. Then we have another called open account. It's a method of making payment for various trade transactions. And in this arrangement, the supplier ships the goods to the buyer. For receiving and checking the concerned shipment document, the buyer credits the supplier's account in their own books with the required invoice amount. The account is then usually settled periodically, say like a monthly basis, by sending a bank draft by the buyer or arranging through what's called the wire transfer and airmails in favor of the exporter. Then we also have the trade finance method. The most popular in the financing methods, we have account receivable financing, a special type of asset financing arrangement. In such arrangement, a company utilizes the receivables, that's the money owed by the customers, as a security in getting a finance or a collateral. So in this type of financing, the company gets an amount that is reduced value of the total receivable owed by the customers. The time frame of the receivable exert a large influence on the amount of financing. For older receivables, the company will get less financing, and it is also sometimes referred to as factoring. Then LOC, I think we have mentioned it on several occasions. So we have bank acceptance is a short-term debt instrument that is made, that is issued by a firm that guarantees payment by a commercial bank. So a bank acceptance are used by firms such as a part of the commercial transaction. And these instruments are like the T-bills and are often used in case of money market funds. They are also traded at a discount from the actual face value. Then we have the working capital finance. Is a process termed as the capital of the business and is used in its daily trading operations. So it is calculated as the current assets minus the current liabilities. Okay. Forfeiting is the purchase of the amount importers owe the exporter at a discounted value by paying cash. So the forfeiter, that is the buyer of the receivables, then becomes the party the importer is obligated to pay that particular debt. Now, once the buyer receives the goods as per the virtual elimination of risk to be performed by the supplier, and the buyer bank tend to support the receivables while enabling the supplier to eliminate the transaction from the balance sheet, thus backing the financial ratios. So trade finance instruments can also be used to limit risk over transactions, and risk can include political and payment risk, transport and shipping, as well as currency risk. Then we have a counter trade. It's a form of international trade where goods are exchanged for other goods in place of hard currency. So it is classified into three major categories: that the barter, like the old one which our forefathers were using, purchase, counter purchase, and offset. So barter, we know, good for good. Counter purchase is a foreign seller contractually accepts to buy the goods or services obtained from the buyer's nation for a defined amount. Then an offset arrangement. Now here, the seller assists in marketing the product manufactured in the buying country, and may also allow a portion of the assembly of the exported products for the manufacturers to carry out in the buying country. So this is often practiced in the aerospace and defense industries. Now, the impact of international policy on trade. When talking about international policy, we are looking at the rules and regulations that guides international trade. What impact do they have? Domestic policies include those policies targeted at domestic production, consumption, and other activities. They include the production or consumptions of taxes, subsidies, as well as the income sales. Now, in contrast, the trade policies are targeted directly at imports and exports, such as the import tariffs. We have the what called the quotas, the export taxes and subsidies. Then we have the production and the consumption taxes and subsidies, which can stimulate imports or exports to occur. So subsidies, when you're talking about subsidies, this is whereby the government pays for part of what the importer or the customer was supposed to pay. So it pays a portion of the price remains the same, but you don't pay the full price for that particular commodity. The government pays a portion of it. We call that a subsidy. Domestic productions and consumption taxes and subsidies will affect the levels of international trade. Now, we have what called the fiscal control on trade. Important objectives of the fiscal policy. One is optimum allocation of economic resources. Now, the aim of the fiscal policy should be so framed as to increase the efficiency of productive resources. That is, to ensure the government that the government should spend on those public works which give the maximum employment, not just spending, but it needs to spend its money on those areas which is going to create more employment for the youth or the citizen of the country. Now, the fiscal policy should aim at equitable distribution of wealth and income. It means that a fiscal policy should be so designed as to bring about reasonable equality of the incomes among different groups by transferring wealth from the rich to the poor. Like in our nation here, we need this kind of policy, the fiscal policy, that equitable distribution of wealth and the income. Let those who are considered to be the poor also get access. And this is one way of ensuring the fiscal policy. In Kenya, for example, was the aspect of devolution, whereby the resources are taken back to the community, to the people, so that they know their own problems. They have their own people who governs their resources. So your own people select your own person so that you can govern, you can manage the resources which have been given so that your area can also develop. Okay. Now, to maintain prime stability, deflation leads to a sharp decline in business activities. So on the other extreme, inflation may hit the fixed income classes hard while benefiting speculators and the traders. So the fiscal policy has to be such as a will maintain a reasonable stable price level, thereby benefiting all sections of the society. So we know um, the effect of inflation. When there's inflation in a country, the money loses its value. The little coin you have brings less of what it used to bring before. And in such a case, we talk about there is a high inflation. The cost of living has risen while your earning remains there. Okay. So the most important objective of fiscal policy is the achievement and the maintenance of the full employment, because through it, most other objectives are automatically achieved. So it is aimed at full employment and visage the direction of taxes, tax structure, not with a view of raising revenue, but with a view to noticing the effects with the specific kinds of taxes have on the consumption, saving, and investments. What are the instruments which are used in these? The tool of fiscal policy are taxes, expenditure, public debt, and nation's debt. Now, they consist of changes in government revenues, rates of the tax structure, so as to encourage or to restrict private expenditures on consumption and investment. And public expenditure include things like normal government expenditures, capital expenditures on public works, like building of roads, constructions of roads, construction of ports and all that. So relief expenditures, subsidies on various types of transfers of payment and social security benefits, just to mention a few. So government expenditures are income creating, while taxes are primarily income reducing. So management of public debt in most countries has also become an important tool of fiscal policy. It aims at influencing aggregate spending through changes in the holding of the liquid assets. Like in our country, we are at a mess. We are borrowing too much. We borrow each and every time we go to other countries and to seek for their to seek for loans, and these loans are bringing pressure to our economy. So during inflation, the fiscal policy aims at controlling its excessive aggregate spending, while during depression, it aims at making up the deficiency in effective demand for raising the economy from the depths of depression. So the following considerations may be noted in the adoption of the proper policy instruments, like we have the contra-cycle budgetary policy. Now, it implies unbalanced budget during depression, which implies deficit spending. And to make it more effective, the government may finance its deficit by borrowing from the banks. And during periods of inflation, the policy is to have a budget surplus by curtailing government outlays. Now, the government may partly utilize the budget surplus to retire the outstanding government debt. And on the taxation policy, taxes determine the size of disposable income in the hands of the general public. And therefore, accounting and inflationary and deflationary gaps. So during depression, that is when things are going down. Tax policy has to be such as to encourage private consumption and investment. While during inflation, tax policy must curtail consumption and investment. Sorry. Now, also we have the public debt, that the government borrowing can be in the form of borrowing from non-banking financial intermediaries, borrowing from commercial bank systems, drawing from the central bank, or printing of new money. Now, borrowing from the public through the sale of the bonds and securities, which curtails the consumptions of private investment, is anti-inflammatory in effect. So borrowing from banking system is effective during depression if banks have got excess cash reserves. Thus, if unused cash lying with the banks can be lent to the government, it will cause a net addition to the national income stream. Okay. Then public expenditure can be used to stimulate production, income, and employment. And government expenditures forms highly significant part of the total expenditure in the economy. So a reduction or expansion in the cost in it causes a significant variation in the total income. So it can be instrumental in adjusting consumption and instrument in achieving full employment. So during inflation, the best policy is to reduce the government expenditure in order to control inflation by giving up such schemes as are justified only during the deflation. Now, while expenditures are reduced, attempts are made to increase public revenues to generate a budget surplus. Then we have a monetary policy versus a fiscal policy, the comparison. Now, monetary policy and fiscal policy refer to the two most widely recognized tools used to influence a nation's economic activity. Monetary policy is primarily concerned with the management of interest rates and the total supply of money in circulation, and is generally carried out by the central bank, such as the Kenya Central Bank or Central Bank of Kenya and the US Federal Reserves. While the fiscal policy is collective term for the taxing and spending actions of the government. So like in US, the national fiscal policy is determined by the executive and legislative branches of the government. Now, what do we note from this? Monetary policy addresses interest rates and supplies of money in circulation, and it generally is managed by the central banks. While on the other hand, the fiscal policy addresses taxation and government spending, and is generally determined by the legislation. And monetary policy and fiscal policy together have a great influence over a nation's economy. So up to there, we are winding up our tutorial. And in case you have any question, kindly use the comment section, drop your question there. I will attend to it in our next tutorial. Otherwise, don't fail to like the tutorial, subscribe, share. Knowledge is shared. Don't be mean with knowledge. The reason why I'm doing this because I know that we need to share what you have with your colleague. Till next time, we'll meet. We'll be discussing chapter 5. That is the principles of importing and exporting. Thank you. And in this case, we'll be looking at the Incoterms. Remember here, we'll be doing the comparison of the Incoterm 2010 and the Incoterm 2020, because currently the Incoterm in use is Incoterm 2020. The Incoterm 2010 came to an end on 31st December 2019. Up to next time, bye. Thank you very much. Have a beautiful afternoon and enjoy your day. So I say bye. See you.